Last video, I told you this would be one of the most visually satisfying lessons in the series. Here's why. Right now, you can probably recognize a candlestick chart. Red and green blocks, little lines sticking out the top and bottom. You've seen it 100 times. But if I paused the chart right now and asked you, what is this one candle actually telling you? Could you answer? Most beginners can't. They're staring at the same information professional traders use to make decisions, and it might as well be in a different language. Not after this video. By the end, you'll be able to look at a single candle or a whole sequence of them and read the story it's telling. Who was in control, how confident they were, and where the fight is happening. Let's get into it. Before we talk about candlesticks, let's talk about why they exist at all. A line chart, the kind you'd see tracking, say, a stock's closing price over time, only shows you one piece of information, where the price ended up at the end of each period. But that hides almost everything interesting. It doesn't tell you whether the price was calm the whole time, or whether it violently spiked up, got rejected, and crashed back down before closing exactly where it started. Candlestick charts fix that. Each candle shows you 4 data points at once: where price opened, where it closed, and the highest and lowest points it touched in between. Traders have used this style of chart for centuries. It actually originated with Japanese rice traders in the 18th century, but the reason it survived is simple. It packs more useful information into one glance than almost any other chart type. Let's break one candle apart. Every candlestick has 2 main parts: the body and the wicks, sometimes called shadows. The body is the thick rectangle in the middle. It represents the range between the opening price and the closing price for that period. The wicks are the thin lines poking out above and below the body. The top wick shows the highest price reached. The bottom wick shows the lowest price reached. Now here's the part that trips people up at first: color. If the price closed higher than it opened, the candle is usually colored green or white. This is called a bullish candle. If the price closed lower than it opened, the candle is usually colored red or black. This is called a bearish candle. So just from color alone, before you even look at the size of anything, you already know which side won that round, buyers or sellers. Here's where it gets genuinely useful. The size of the body tells you about momentum. A long body means one side was firmly in control the whole period. Buyers pushed price up hard with barely any resistance, or sellers pushed it down hard. That's conviction. A small body means the opposite. Buyers and sellers fought each other to a near standstill, and price ended up almost exactly where it started. That's indecision. And the wicks tell you about rejection. A long upper wick means price tried to go higher, got rejected, and sellers pushed it back down before the period closed. A long lower wick means the reverse: price dropped, buyers stepped in, and pushed it back up. There's actually a special candle where the open and close are almost identical, so the body nearly disappears. It's called a doji, and it's one of the purest signs of indecision you'll see on a chart. We'll go much deeper on named patterns like this in a future video, but for now, just recognize it when you see it. A tiny, cross-shaped candle means neither side won. One thing that confuses total beginners: a candle isn't a fixed size. You choose what each candle represents. On a 1-minute chart, each candle shows everything that happened in that 1 minute. On an hourly chart, each candle summarizes a full hour. On a daily chart, one candle is an entire day's trading. Same market, same price data, completely different looking chart depending on the time frame you pick. Here's the practical takeaway. Higher time frames, like daily or weekly charts, show you the bigger picture, the overall trend. Lower time frames, like 1-minute or 5-minute charts, show you short-term noise, which can be useful but can also be misleading if you're not careful. Most beginners should start by getting comfortable reading higher time frames before zooming into the noisy short-term stuff. We'll cover how to actually combine multiple time frames properly later in this series. One candle tells you a moment. A sequence of candles tells you a story. A run of long bullish candles, one after another, with barely any pullback, that's a strong, confident uptrend. Buyers are firmly in control. A cluster of small candles overlapping each other, going nowhere, That's consolidation. The market is pausing, catching its breath, deciding what to do next. And here's the one that matters most for what's coming next in this series. When you see a long run of bullish candles suddenly followed by a long bearish candle that wipes out several periods of gains, that's often a sign something has changed. Momentum has shifted, and the level where that happened tends to matter a lot going forward. That idea, specific price levels that seem to matter, again and again, is exactly what we're covering in the next video: support and resistance. Reading candles is the foundation. Reading where they cluster and reverse is the next skill on top of it. Let's lock this in. A candlestick shows four things at once: open, high, low, and close. The body is the range between open and close. The wicks are the highest and lowest points reached. Green or white is bullish, closed higher. Red or black is bearish, closed lower. A long body means strong momentum. A small body means indecision. A doji is the extreme case. Long wicks mean rejection at that price level. Every candle represents a time frame you choose. Higher means big picture, lower means short-term noise. Read candles in sequences, not just one at a time, to see the full story. That's a candlestick chart, fully decoded. No more staring at red and green blocks wondering what they mean. In the next video, we're building directly on this: support and resistance, the invisible price levels that the market seems to respect over and over again, and exactly how to spot them on your own charts. If this clicked for you, hit like. It genuinely helps this channel reach more beginners who are stuck exactly where you were 5 minutes ago. And drop a comment below. Now that you can read a candle, which named candlestick pattern do you want me to break down first? I'm planning that video already, and I'll pick from your replies. See you in the next lesson.